Financial Regulation. Mr. Kevin Jerome Matthews is an Air Force veteran and Maryland homeowner who's experienced mortgage lender abuse. And we're being joined by Ms. Jane Wilson. She's chair of the board of St. Ambrose Housing Aid Center here in Baltimore. St. Ambrose is a housing counseling agency founded in 1968. And I might note for the record that we have now received your opening testimony, so that will complete the record. And I want to personally thank you, Ms. Wilson, for coming in. You were a last-minute inclusion, and I appreciate your coming here today. Pursuant to the rules of the committee, if you could please rise and take the oath. Do you solemnly swear or affirm that the testimony you are about to give before this committee will be the truth, the whole truth, and nothing but the truth? The record will reflect that all witnesses answered in the affirmative. Now I'm going to announce, because you were all here patiently on the previous two dignitaries, that the rules of the committee are that opening statements will be for 5 minutes. Your entire written statements will be placed in the record. And as my predecessor chair said, everywhere in America, a green light means keep talking, a yellow light means wrap up, and a red light means stop. So if you could observe that, it would be very much appreciated. I know there will be a lot of follow-up questions, and again, your full statement will be placed in the record. With that, we'll first go to Mr. Call.
Thank you. Chairman Issa, Ranking Member Cummings, members of the committee, thank you for the opportunity to testify today. My name is Mark Coffin, and I'm the State's Commissioner of Financial Regulation. As the Governor has described, foreclosure issues have been a focus for those of us at the state level for years. They're more than numbers or percentages. They are phone calls, letters, and emails from constituents with desperation revolving around their situation, and scams that evolve within the crevices of the law. With the Governor's leadership, the state has taken significant steps to address the problem, reforming the entire foreclosure process and more recently implementing a mediation program. As Commissioner, my office has also played an active role. We've used delinquency data that we received to send over 250,000 outreach packages to severely delinquent borrowers. We've launched an examination program that has resulted in hundreds of thousands of dollars of refunds to consumers. And we've also implemented a reporting requirement, at the time the first of its kind at the state level, for licensed mortgage servicers. When we required servicers to report not only data, we required them to report not only the number of modifications that they were achieving, but the impact of those modifications on the borrower's monthly payment. Shockingly, the early results documented that for most of the borrowers who successfully ran the gauntlet of modification, they wound up paying more when they were finished than when they started. These modifications seemed doomed from the start. When the federal regulators began to collect data, we urged them to also collect data on the impact on payment. It took more than 8 months and several requests from our congressional delegation, including from Congressman Cummings, before the OCC agreed to collect data on payment terms. Our office has also partnered with other states. Together with 4 other banking commissioners, we joined 12 state attorneys general in 2007 in the State Foreclosure Prevention Working Group, led by Iowa's Attorney General Tom Miller. The group published 5 reports between 2008 and 2010, and forms the foundation for the robo-signing investigation, which I'll describe in a moment. Many of the problems that we face today are a function of changes in the mortgage market. Today, as you know, most mortgages are originated, securitized, sold, and serviced by different parties. This unbundling process may reduce costs and increase efficiency, but it has also fragmented roles, distorted incentives, and severely complicated the effort to avoid preventable foreclosures. In theory, servicing is a scale business. This is certainly true when things are going well, as automation created profits while driving down costs. When the mortgages began to default, however, the situation flipped, leaving servicers without the expertise, the resources, and the incentives to meet the new need. To make matters worse, the same economies of scale drove consolidation. The percentage of the market in servicing handled by the top 5 servicers in this country has doubled over the last 10 years to over 60%. Beyond the increased management challenge of operating these behemoths in a crisis, they are virtually all owned by the major banks, the same banks which are too big to fail. reasonable returns for a well-run and operated business is impaired, in large part at the expense of the homeowner, who has no choice in who his servicer is. The invisible hand is essentially broken. These issues were thrust into the public eye with the recent robo-signing scandal. As the governor has described, the response in Maryland was swift. Our elected officials, including the governor and Congressman Cummings, called on the servicers to halt foreclosures until their processes could be validated. Our courts implemented new rules on an emergency basis. My office, through the working group that we were part of, joined the 50-state HE investigation along with 37 bank regulatory agencies. I'm proud to serve on the executive committee of that investigation. Without going into the details, let me make the following observations. First, this is not just a technical issue. As our courts have noted, due process and the rule of law are not to be trivialized. More broadly, the problems are symptomatic of the broken process that has been described today. We've seen incomplete files, shoddy record keeping, in certain instances, inaccurate loan data. Third-party oversight is weak, as evidenced by the improper affidavits that we've seen here in Maryland. And we continue to see borrowers giving mixed signals, believing they're on the road to a modification, only to find themselves deeply down the road to foreclosure. And these are not only our findings, by the way. The FDIC, the Fed, the OCC have also publicly acknowledged similar issues. The public senses the same problem, that is why the term robo-signing has caught fire. It embodies everyone's sense that while servicers and borrowers are struggling along, the foreclosure process is operating in the next room unencumbered. Let me quickly, as we look to the future, let me quickly talk about the things that we see as necessary. Ultimately, we believe that borrowers need a single point of contact in order to move through this process. As I've indicated, we also need to have servicers, these single points of process need to be backed by adequate staffing and training and support infrastructure. As I've noted, I question the profitability of the entire model, so I believe those issues will have to be addressed by demands rather than by requests. I also believe we need to increase accountability and third-party oversight. None of this will be easy and none of it will be free. But as I've mentioned, I believe that the invisible hand of the market will not fix it, at least not in any near term, and not without a lot of continued human costs and economic costs. I thank you for the opportunity to testify, and please answer any questions.
Thank you. Matthew. Could you put the mic a little closer?
Mr. Chairman and members of the committee, my name is Kevin Jerome Matthews. I'm here to talk to you about the Mortgage Foreclosure Act. By the way of brief background, I'm a former high school JROTC cadet, member of the U.S. Air Force and Marine Army National Guard, and served with 243rd Engineer Company in Iraq. In 2008, with the help of the VA Guarantee Loan Program, I purchased my home on 3216 East Northern Parkway. When I purchased my property, I had a good income. I was a contractor for me, field of wastewater. I also made I made all my mortgage payments on time and everything was going okay. But in December of 2008, I was in a horrific car accident that made my previous injuries worse than before. In February 2009, as a result of my injuries and resulting in continued absence from work, I was laid off from my job while I was in the hospital. Realizing the difficulty of my situation, in an effort to be proactive, I contacted my mortgage services, USA, to inform them of my hospitalization, disability, and anticipated financial hardship. I continued to contact USA after my release from the hospital and during my rehabilitation, and they continue to keep them informed of my situation and to see if I could secure any help from them while I had no income, including the possibility of a forbearance or modification. I made every effort to keep up my mortgage payment, including draining all of my 401k, using my tax returns and short-term disability benefits. I also did not pay any other bills in an effort to keep my mortgage current and depleted all of my savings. In July 2009, I ran out of money, and in August, I officially went 30 days late. I continued to contact USAA in an effort to find a resolution to the delinquent payments on my home. I wanted desperately to save my home or find any other alternative to foreclosure. After contacting USA more than 50 times over the course of 12 months ago, I retained as one of the best housing counsels in the state. USA proceeded to sale on May 21st, 2010, with USA not even looking at my mitigation package. On the phone, I was told they did not care and it wasn't their problem. Consumer Protection Clinic, and my lawyer filed a formal exception to the foreclosure sale with the court. While the exceptions were pending consideration of the court, and before the lender had the legal right to acquire possession of the property, I was required to go out of town for an internship related to my status. I returned home to learn that my house had been taken over by the lender without permission of the court, and that a lockbox had been placed on my front door, that all my personal belongings, as well as that of my sons, had been taken from the house by the lender's aide who secured the house. In addition, as a result of the legal lockout, I had to go find an apartment and buy all new furniture and clothing for not only myself but my son. To this date, I have never received my property back. After I obtained legal counsel of civil justice and the University of Maryland Law School of Consumer Protection, I also learned that GMAC and not USA owned my mortgage. Apparently, to what USA had told the media, it permits GMAC to use its name for customers like me, so we don't know the loan has been transferred. I have also learned since the foreclosure, my loan was a VA guaranteed loan. The VA required my lender to undertake loss mitigation efforts prior to foreclosing on the loan, including a face-to-face meeting, review of my loan, and circumstances for modification. The possibility of temporarily modifying my loan to allow my conditions to improve, the exploration of the possibility of a deed in lieu as an alternative to foreclosure as a last resort only. None of these things were done for me. In the fall of 2010, when the national and state robo-signing scandal came to light, we learned that an individual by the name of Jeffrey Stefan had admitted under oath in a deposition that he had signed tens of thousands of bogus affidavits used to initiate foreclosure proceedings on behalf of GMAC and other lenders, including my own foreclosure. Apparently, Mr. Stefan never reviewed the required documentation, and the affidavits were falsely notarized without Mr. Stefan being present as required by law. After the hearing, we have attempted to secure the keys to the lock GMAC had illegally placed on the door of my home. However, they never gave me they never gave my counsel the keys, and as a result, I had to break into my own house. Unfortunately, the neighbors who didn't know me called the police, and I had to explain this entire situation to them. Luckily, I wasn't arrested, though. Upon entering the house, I found that the house had been not properly winterized by the company hired by GMAC to discontinue with the utilities. As a result, my sewage pipe and hot water heat cracked from the water expansion in the cold weather, requiring me to fix both in order to move back into use of the house. Mr. Chairman and members of this honorable committee, as a member of the armed service, I took an oath where I rose my right hand and stated that I solemnly swore to support and defend the Constitution of the United States against all enemies, foreign and domestic, that I will bear true faith and allegiance to the same, and that I will obey the orders of the President of the United States and orders of office appointed according to regulation and the Uniform Code of Military Justice, so help me God. I did all that was asked of me proudly and unreservedly. Today, I am here not to tell you my story, but to ask each of you that you assist not only me, but the tens of thousands of homeowners throughout this country to receive the equal protection of the laws and rights to due process that are guaranteed to each of us, but that very same Constitution that I was asked to defend. I am an example of everything that can go wrong when lenders abuse the system and not held accountable. Hopefully, through the actions, through homeowners trying to be proactive and do the right thing, that they will not have to endure what I have suffered through and continue to suffer through each day. Thank you for your time and efforts to work together to find a common sense solution.
Thank you, sir. Ms. Goff.
Chairman Issa, Ranking Member Cummings, and members of the committee, thank you for allowing me to be here.
You might want to pull the mic just a little closer.
Thank you for the opportunity to allow me to be here today to share with you the experiences of Maryland homeowners facing foreclosure.
Just a lot closer might be better. They try to compensate that because.
And also the steps that St. Ambrose is taking to try to preserve sustainable home ownership and neighborhood stabilization. By way of background, St. Ambrose Housing Aid Center is a non-denominational 501c3 nonprofit located here in Baltimore. We are a HUD-certified counseling agency and a chartered member of NeighborWorks America. Since our founding in 1968, we have provided direct housing services to over 100,000 low and moderate income families through our several interrelated housing programs. In particular, our foreclosure prevention division provides default counseling services and direct legal representation and legal counsel to homeowners and nonprofit housing agencies across Maryland. St. Ambrose has been involved with foreclosure prevention for over 30 years. During that span, we have witnessed a dramatic change in the face of foreclosure. In particular, over the last few years, our attorneys and housing counselors have found and continue to find that homeowners eligible for certain types of loss mitigation relief, including relief available under HAMP, face impending foreclosure sales of their homes despite having submitted applications for review under the applicable state, federal, and investor-specific loss mitigation guidelines. We have never before witnessed such systemic and deliberate dysfunction at the large mortgage loan servicers that has resulted in the sizable loss of wealth to homeowners and communities across Maryland. We recognize that not every home can be or must be saved in the process, but the losses are not limited to the homeowners. We also see the sizable losses to investors, taxpayers, and the government as a result of the systemic failings within the servicing industry. Time does not permit me to recount each example of servicer failings that I've provided in my prepared testimony, but I would like to highlight one example. I wish I could say this one example is an isolated case. It is not. I also wish I could say that the described events that occurred in 2008 or 2009 would not occur today, but I cannot. We had a client who came to us in late 2008 with her mortgage payments 2 months in arrears. Between December 2008 and February 2010, our housing counselor helped her submit the necessary loss mitigation information to the servicer on 10 separate occasions, only to be told more than 30 days after each submission that the modification package was incomplete. Our client finally received a HAMP trial period plan in February 2010 and made her first payment. Only a few days later, she was notified that the servicing rights had been transferred to another servicer who claimed that they had no record of the HAMP trial plan, and that if she wanted assistance, she'd have to start over again. Most recently, the current servicer offered our client an unaffordable repayment plan, not a modification, but a repayment plan that required a payment approximately $800 a month more than her pre-hardship payment. As you might anticipate, this was not a viable option for the client. One of our attorneys continues to advocate for a modification for this client. I might note that the servicer failures in this case are particularly frustrating because the loan is owned by Fannie Mae. Efforts by St. Ambrose staff to discuss the case directly with Fannie Mae have produced no results. The servicing industry must be repaired. The problems within the industry from our perspective,
But it still doesn't excuse USAA for any portion of their involvement or any of the other entities involved. And I sincerely feel for, I guess, what is now a corrected loss, but not fully corrected, and probably won't be fully corrected for a long time. Ms. Wilson, I particularly note that when we look at Freddie and Fannie, they do hold $7 trillion worth of these notes, the largest holders by far. So as we talk about servicers, obviously we're really talking about servicers on behalf of GMAC, in some cases, Freddie and Fannie, entities that were bailed out and continue to be bailed out by the U.S. government. So, Mr. Kaufman, I'll go to you. First of all, there was some talk about modified bankruptcy. From your past experience before you came into your current job, if we were to open up the door of cram downs broadly, the way they were in the 80s and 90s, what effect would that have on commercial construction and all the other entities that used to avail themselves of cram down briefing?
I'm not sure I'm exactly in the best.
But another way to put it is, what would it cost if bank consortiums that were funding shopping malls and large home development plans suddenly had to look and say, if anything goes wrong, we're not even going to have the right to take back the property. We're going to be forced into a cram down. Maybe as many as 3
I'm not sure that it's sort of statistically possible to make an estimate. I guess I would make 2 points. From at least one from previous experience working as an investment banker, which is the leverage to hand back the keys to, that's how workouts get done. You know, we hear a lot about borrowers who are not holding up their end of responsibilities, who are acting immorally, et cetera, who, you know, I would observe act a lot like corporations or investors that I work with, and nobody questioned their morals. That was really just how business was done. I also think it's difficult to estimate. I mean, at some level, costs would go up, but I'm still frankly looking for the study that even shows you that the cost of an elongated timeline for foreclosure, or for some of the foreclosure reforms that we've put in place, raise the cost of credit for consumers. So, for example, when we talked about changing the foreclosure process, one of the issues was if you do this, this, or this, everyone will pay for it. The person will get a benefit, but every borrower will pay for it in terms of increased rates. We have a 50-state petri dish of experimentation with different foreclosure timelines, and I'm not aware of massively different interest rates in states which have extremely rapid foreclosure timelines versus states that don't. It's a national market, and so if that was a huge impact, I would think we would see it. But at this point, we still
following up on that, you know, home mortgages are almost always non-recourse. So basically, the only asset you have is the property itself. Maryland's no different. You're a non-recourse state. Is that correct?
I believe that's correct.
Okay. So knowing that you know, you can't go after other assets. Earlier testimony by the mayor, 40% of all the properties in foreclosure that she dealt with were rental properties. Basically, you had somebody who was collecting the rent, not paying the mortgage, and you couldn't go after their other homes or property. Realistically, the question about being able to go after other property, recourse versus non-recourse, and all the other mortgage questions that I asked your governor, aren't these all things which the petri dish, as you said it so well, could be dealing with? In other words, before you come to the federal government for bankruptcy change and others, aren't there some areas in which states could and should begin making those changes so that they protect constituents from an unreasonable foreclosure?
I guess yes, in the general sense, and I think we have been trying everything that we can throw at this problem. At a high level, I think the governor's responses are open to any suggestions that people have. We have elongated timelines. We have gone after servicers. We have undertaken examinations. We have tried everything we can.
In Mr. Matthews' case, for example, he was not given a mandatory mediation where he could have shown how absurd the foreclosure process had become and how there had been no attempt to legitimately look at his willingness to pay, his willingness to liquidate his 401 and all the other things that he did. In a sense, your state fix should have, if availed for Mr. Matthews, would have helped him. Is that correct?
Well, our state fix is an opt-in program, so we would have had to opt in. My guess, without getting the timing, is the program just went into effect in July. The law just passed. I'm not sure that there would.
Right, that's where I said if it had availed.
The intent is to address that.
Okay, so you have some fixes which in the future might protect Mr. Matthews, and others are possible.
After a lot of damage is done, but yes, we are trying, yes.
I thank you. Recognize ranking member for 5.
Scott, just following up on the chairman's question, and reading your testimony, which was excellent, by the way, throughout that testimony, you seem to express some frustration with regard to things that is with regard to the limitations of the state. In other words, you only can go but so far. Can you comment on that and why it's so important that we act on the federal level?
Well, I mean, on a couple levels. In very real terms, you know, the vast preponderance of mortgages in our state and every other state are serviced by institutions which are primarily federally supervised. So I supervise 50 community banks on the bank side as banking commissioner. We get virtually no complaints relative to their mortgage practices of any scope. The vast preponderance are coming from institutions that I have no jurisdiction over from a supervisory standpoint.
Because they service their loans. Is that right, basically?
Because if it's a national bank, I don't have any jurisdiction.
I'm talking about the community banks.
The community banks largely own, own and service their own loans. So that's the piece of it. The other piece is even where we have the jurisdiction, quite candidly, these are national operators operating out of state, where we're trying to run an examination program, trying to oversee institutions that are largely beyond the physical reach of our employees with very limited resources. Where you're able to identify clear violations that you can go after, that's one thing. When you start trying to address sort of system-wide practices in an institution, there's a limit in the sense that ultimately it gets down to, are you willing to pull the license? Are you willing to go in and tell X, Y, Z service that they simply can't operate in your state, which is going to impact the vast preponderance of their customers who are actually paying. So there is a limit to what can be addressed even where you have regulatory authority.
Now, with regard to the robo-signing situation, you commented on that. How many people did that affect in Maryland, if you know?
I don't think we know at this point. And I would point out again, I think it's, and this is why again, I think that the term has caught such fire. It's less sort of technical. There's a lot of, this is a technical issue, it's a touch valve. It's more, I think, just sort of captured everybody's sense of exactly the sort of impersonal, methodical nature of what's going on.
One of your recommendations was that the servicers staff up, that they have more staff, and I just want to comment on that, because I used to wonder whether or not they had any staff. Seriously, it just seems like these papers were going in, they were being faxed right into a trash can. So I was just wondering, is that?
I think resources have been an issue from the word go. I think at the end of the day, they have staffed up, they have added resources, they haven't added fast enough. And I go back to, I know that there's a lot of sort of this constant hand-wringing from regulators and constant sort of, political pressure, et cetera, public pressure from governors and mayors and so forth. But, I believe that the bottom line is these guys are not profitable. So it's very difficult to ask a money-losing enterprise to expect that they will sort of on their own continue to invest in issues that they need. It's going to have to be demanded, not requested. And I think that's why it's been slow to come.
Which entities do you say not profitable?
My point is the business model. My sense from the first time I started talking to servicers 3 years ago is that they signed up thinking they were going to take payments, receive payments in mail statements, not run call centers, not do massive mediation, not run their business the way a collection agency runs. I used to go see collection agencies as an investment banker, and the first question you'd ask is, what's your turnover in your calls? It's 100%. If it's under 100%, it's a well-running collections agency. So these are very difficult businesses to operate. And I don't think they had any, I know they didn't have any plan to get into that business.
So they never were equipped to even do this. So that means that is.
They've been chasing, I think we've been chasing, everyone has been chasing this problem the whole way.
Now, you heard the testimony of Mr. Matthews. Could he have been helped through this mediation process, do you think?
Well, ultimately, if we had gotten mediation, we'd at least be able to get the right people in the right room. There's sort of a sense of how do you know there's a problem that can be fixed. I think all of us that have escalation contacts, we have them, I know your office has them. When you escalate, they get fixed. And sure, maybe some number that get fixed because of the ranking member or the chairman wouldn't have gotten fixed solely on their economics. I'm not that high up the chain. When they're getting fixed because of our escalation contacts, I believe they're economic. And they still get fixed when we escalate.
Thank you.
Mr. Walford.
Thank you, Mr. Chairman, and appreciation to each of you as witnesses today and what you bring to the table. Ms. Wilson, thank you for the work you do. Mr. Matthews, thank you for your service to the country. Hearing your testimony and on face value what you've said here, you were submitted to the unjustified perfect storm of a breakdown that went there. And I just wish the best as it moves forward here. And I think these hearings, and as we consider further, hopefully we will come to some conclusions that will benefit others as a result. clearly that mortgage servicers did not have the expertise, the financial incentives, or resources to engage in large-scale mortgage modifications when foreclosures began. The question I would ask in context of HAMP then, the servicers didn't have these incentives, resources, or expertise. Did HAMP provide them with expertise that they needed?
No, I think the intention was to try to provide this through an incentive, at least solve the incentive part.
Did HAMP provide the incentives necessary?
Necessary, I don't know, and it certainly tried to provide additional incentives by definition.
For large-scale modifications?
For modifications that were done, correct.
What about the resources? Did HAMP provide the resources necessary?
No, I mean, look, I'm not gonna, I know there's a lot of concern about HAMP. There's a lot of disappointment with HAMP. I share that disappointment with all of you. It's no secret that the program has not lived up to anyone's expectations. The program did not provide expertise. I will say one of the things it did do was begin to standardize a completely unstandardized modification process. I think you sort of have to grant, it was the Wild West of modification. When we started gathering modification data pre-HAMP, it was all over the board. And again, it was shocking to me as a former business person that most people who got a modification wound up paying more after than before. We didn't put it in our initial data.
So in some ways it escalated the problem.
Yeah, you could look at these and scratch your head and say, well, how does this work? I mean, I couldn't see the underlying case, but the numbers were big enough that the rational conclusion that if he's here looking for a modification, what's the likelihood he's going to be able to pay more next month than he could pay last month was an estimation.
To say the least. Ms. Wilson, thinking of Mr. Matthews' experience here, and from your experience working with cases like this, what was the first step that was missed? What would you have had you work with Mr. Matthews? I assume you didn't work with Mr.
No,
Matthews.
our organization did not work with Mr. Matthews.
What would have been the first step that was missed? And what would you have taken action on to deal with that, to give us instruction on how we can move from here?
Well, I think that, I believe Mr. Matthews did have, he went to one of the local counseling agencies and did have counseling. I don't know, I can't say for sure that things would have been any different had he come to us. There are several very good peers of ours in terms of counseling.
I don't want you to dump on any of the other peers. I'm not asking that, but I'm just hearing a complete breakdown. In this case, we're not talking about the stereotypical underwater mortgage from the very get-go. We're talking about a military service personnel who had set up plans, had finances in place, had a job that was stable, but for the fact of an accident, as I hear the description here, and all of a sudden it just escalates. And how would we stop that?
I think the way we stop it is to get the servicers to do what they're supposed to do. Exactly what method we have left to use. I don't know the right answer of how we get there. But I think this is yet another situation where we've got a breakdown with the servicers, no matter what kind of assistance the homeowner has on his side.
I appreciate that. Thank you.
Thank the gentleman. Jeremy?
Thank you. I think, Ms. Wilson, you're right. What we have here is insufficient regulatory work resulting in a mess for a lot of people on it. So how do we work ourselves out of that? Mr. Calvin talked about possible incentives. I tell you as a taxpayer, it's a little offensive to think that you have this free market enterprise that wasn't regulated properly has caused a huge mess, and now in order to get them straightened out, we can pay them or give them some incentive on that. I like the demand side a little bit more. We just make them step it up and do it right, and that's why we talked about cram down, which instantly wasn't a broad-based cram down that would affect every single mortgage in the world going forward. In fact, backward, and all people on that was very narrowly targeted grant authority that we had talked about and put forward on that. You know, I think that's going to take that. It's going to take somebody demanding or forcing these banks to step up and do what they should do. After having put this country in the condition it's in, I should think that we'd find a way to do that. And I mentioned some of the earlier comments made to the other panel. I think we'll let that stand on the record. Let me ask you, Mr. Kaufman, if we were to eliminate him, what do you envision the situation to become?
It's not going to help, let me put it that way. I mean, that's my concern at the end of the day. Look, the program is not perfect. But I think at some level, you first have to put it in context of where it came from. You know, when we started at this, and prior to him, when we started gathering engagement, it was Hope Now, which was essentially an 800 number in some counseling. And we weren't doing very well, to say the least. So I think trying to refine this program and trying to push it forward and continue to push the process forward is important. Before it's, the other thing I would observe based on what we're seeing from the robo-signing effort is if we're going to declare, ultimately just throw out the program or throw out the baby with the bathwater, we're doing it in the context of very poor execution on the part of the primary party in execution, which is the servicer. So we'd like to try, we are working to try to remedy that. Certainly the state AGs intend through this settlement to the extent we can do it to try to reform practices.
Ms. Wilson, you're doing great work, and I thank you for it. You're doing essentially the work that our constituent representatives are doing in our office, and they're pulling their hair out. So I can only imagine what your organization is going through on that. But you indicated that you're sort of lost as to how we resolve this problem. So something I won't ask you is I think you've already answered that. But Mr. Kaufman, if you're going to keep camp, what do you do to make it work in a way that doesn't get you so angry you want to throw away?
Well, I mean, I think we've talked about some of the things that we would intend, we think need to be fixed more generally, and they apply. We'd like to see better third-party review. I think some sort of ombudsman or something within the program for appeal. I think that the lack of technology for input into this process is pretty poor. The fact there's not sort of a single portal, which is being talked about on the state AG side, for people to be able to get data and information into this, better visibility for a consumer. I mean, I've had the sense throughout this that as a current borrower, that you have relatively good visibility into your mortgage as long as you're paying. As soon as you stop paying, it's a completely opaque process that you can't really exercise on behalf of yourself. So we'd like to see that. We'd like to see the timelines upheld, and that applies to HAMP and other ones. I mean, I think a lot of this applies to everything, and not just HAMP.
So the question comes out, who's going to pay for this? Who's going to pay for the personnel? Who's going to pay for the technology? What's your recommendation there?
The servicing industry is going to. I come back to, I sort of had this sense out on the scientific study. These were freestanding small businesses, they would go on. And the next guy that got hired to do it would say, I'm not doing that for $1. It costs $5. And that would be painful, but we have a process where the market would provide $5 of service, I would think. We're not getting there. We're not going to get there naturally, at least not in the short run. I mean, in the long run, this industry will reprice. There may very well be special servicers, for example, who do only delinquent loans, which is what happens in commercial loans. And that may happen. And that may work fabulously well in 2015. But for the people that are in the process now, that's not going to get them there.
I guess I'm still at a loss. How are you going to force those services that you're telling us are tapped out right now, don't have the resources? How are you going to force them? The people that are basically the ones that start with the banks.
The institutions that they sit within are not by any means tapped out. I think there is someone in many instances who goes to a quarterly board meeting and announces how much money his division just lost and says that he needs to lose even more in the next quarter. And my guess is that your corporate advancement is not solid if that's true.
I want to get that a little clearer on the record. We're talking about the people with the deep pockets, the ones who got us into this mess in the long term, the ones who have to pay to get us out.
Yes.
Thank you.
Sure. Just to put it in his testimony very clear, what you're talking about is deep pockets at major banks are not paying, are not in fact hurting, but the servicers, which are either different divisions or different companies, are in fact undercapitalized to do this, and that's part of the reason that Mr. Matthews and all these others have run into robo-signing and so on, is that the compartmenting, we see the large profits of B of A, we don't see the servicing entity separately. Is that correct?
That's my sense. I mean, I don't have somebody's balance sheet. It strikes me that it is very unlikely that a transaction processing business model that has suddenly become a call center, which is what's happened, it can operate on economics that look anything like what they were designed to.
Thank you. That's one thing that our committee can find out for the record from others that we
I
would
mean,
have.
I know that, and it was why I tried to look, the GSEs are trying to look at incentive, the compensation models for that very reason.
Thank you, Mr. Ross.
Well, this is helpful. I mean, the services will never be able to staff up to do the job if the more they staff up, the more they lose. It just won't happen. That's more or less what you're saying.
It won't happen quickly.
Well, it won't happen.
It won't happen without a lot of duress, and I think that's why it's taking public pressure, events that have happened in districts to governors.
But just explain this to me. The big banks, I mean, most of these loans have been sold, right?
Correct.
So,
Some of them are sold in service by the same institution.
right, but many of them are owned by like pension funds. They're owned by, pension funds investors who had no clue as to what the future would be any more than the servicers did. So it's not just all owned by the big banks. Am I right?
Correct.
So on a practical level, if the owners of the loan ultimately have to be brought to the table to make a decision about whether that asset, which is depreciated by 40%, should be a markdown, right?
Correct. But it falls to the service provider to provide the level of service to even get to the decision-making process. And that service provider,
Right, but if
has to
you
provide the
have
service.
this loan, you know, is it my mortgage, Mr. Matthews' mortgage, let's say, is divided into 20 different tranches. So literally, there's 20 different owners out there somewhere that are making a claim on Mr. Matthews, and you've got a servicer trying to balance the competing interests of those 20 different owners. How does that possibly get done?
Well, that's a whole, the conundrum of the fragmentation of the underlying security is sort of a separate issue from the problem that
So,
you can get to, but that doesn't, that is another layer of complexity.
Two things seem to get in our way. I mean, one, oftentimes we get into the argument about who's responsible. The big banks, the mortgage originators, the individual homeowners who bought a mansion when they could have settled for a house. There's plenty of blame, Freddie Mac, a lot of focus there, and there's plenty of blame to go around. And I think what we're hoping on this committee is, look, we got a practical problem. We have the governor in here, we have the mayor in here, and they're dealing with the devastating consequences of people getting foreclosed on, neighborhoods starting to fall apart. It's really bad. So I see this as a practical problem. It's very difficult to resolve because there is such fragmentation. So if you had a suggestion on something concrete, or we just sort of put our guns back, our rhetorical guns back in our holsters for a while, and stop having the debate about who's at fault, because there's plenty of fault to go around. What would be a practical way where basically you'd be able to, sooner rather than later, make a decision on, all right, this loan's hopeless, and it will be foreclosed. This loan could be saved if we made some modification. And what would be the legislative or legal things we'd have to do in order to allow that to happen?
Well, that's what that's what the program is trying to do with the NPV calculation, which is a little opaque to those of us on the outside, and that's essentially the calculation that's trying to be run to give some better clarity as to what's in it and harmonization.
But at the end of the day, nobody has authority. You've got a servicer who has a bad business model.
The servicers, I mean, we've talked to, and it's been a little while, but when we did our initial round at the behest of the governor, met with the servicers, and we said, do you have the authority to do what you need to do? They generally said yes. In fair, I mean, it was not a legal question, although we did have, and I would again give HAMP some credit for this, we did have people say that if we don't do, we have to defend what we do as prudent and ordinary course of business practice. And in that regard, I would note that the modification program has at least provided some notion of what is routine and ordinary course, which presumably gives them better defense. But they didn't come in, frankly, as aggressively as we expected at all with, hey, our hands are tied. That's not it.
Well, thank you very much.
John, you-
Yeah,
Just one clarification, going back to something that the chairman said. Mr. Coffin, when we have a situation where, I mean, a lot of these servicers are owned by the banks, right? We used to talk, asking about deep pockets. Is that right?
Yes.
Would you have a percentage of, would you guess?
Of the top 5, well, one of them is state licensed, but it's a subsidiary, but they virtually all are. I mean, as our jurisdiction, as a licensed servicer, because we don't do much of our reporting anymore, because the number of people who have to report to us is below 15% of the market.
All right, thank you.
So that gives you some proxy.
Thank you.
Could you stay for a few more follow-up questions? Mr. Carlton, you actually scared me a little bit when you said, basically like commercial, we should work to workout units. You know, there are all kinds of workout units in the commercial market, and I remember from my own days in business, you know, you do anything to modify not to go to that workout unit. But your point, and I think the ranking member hit it very well, there's basically an artificial wall between the servicing division and the banks if the bank's holding the mortgage. If the bank's not holding the mortgage, if Freddie and Fannie or some other entity, some pension plan or whatever is holding it, then it really isn't artificial because that entity's line doesn't go back to the bank's capital base, it goes back to the federal government. Is that correct?
If I'm following correctly, yes.
Yeah. So, as this committee goes through its due diligence to try to get through, and the gentleman said, you know, our guns and the blame game, and he's right, that often is part of what the committee does, but also figuring out how do we get a reform and where do we get the money for a reform from. Currently, Freddie and Fannie have received over $150 billion. HAMP has obligated over $30 billion. So it appears as though Freddie and Fannie are still losing money, and their $7 trillion portfolio would be well served if this system worked better. Do you agree? So when your background, how often do you see any difference in the actions of a servicer based on whether the GSEs hold the loans or some other entity? Do you see any discernible difference in how the servicers do their job?
When the cases come to us, that's not really an issue that seems to come up, frankly.
So if, and this is my real question here that I've circuitously got to, if we bring Freddie and Fannie in, and perhaps a third largest holder of this debt, and we ask them what they are going to do a better job of interfacing with the servicers to get the right outcome, to minimize foreclosure, to maximize benefit for these values, do you believe we'd be well served in pushing that end of it? Because you mentioned that the servicers only have so much money, but the real loss is that the GSEs.
I think the GSEs are, I mean, my understanding, and you all are closer to this than I, is that the FHFA and the GSEs are already looking at compensation practices and trying to see what they can do to reform servicer compensation in order to better align incentives, so yeah.
Although it's been several years since this problem began.
I'm not here as a defendant,
So,
but I think they do recognize the issue, that the system needs to be addressed.
this is one of the problems we find in government is everybody's about to reorganize about the time we're willing to close down something. It seems to be miraculous how that works. Anyone else need a follow-up? Just
Going back, you know, we've got a situation where, Mr. Matthews, I'm just curious, did you ever, you said there was quite a bit of damage done to your place, did you, what kind of money did you have to spend for that?
Basically, winterizing the house. I know specifically about what we put into your pipes. You basically had to winterize the place, drain the pipes, fix everything. So it's cold. Basically, the pipe was freezing.
So what did it cost you to get?
It cost me approximately $1,500 to replace the hot water heater and a stack pipe in my house.
And you haven't been reimbursed for that?
No, sir, I haven't been reimbursed for that either.
I'm sorry you went through all of that. So you're still in the process, your lawyer's behind you, you're still in the process of going through this?
Yes, sir. There's been a long court process, basically. We're still moving process as we speak.
Just two documents I want to get into the record, Mr. Chairman. Former City Council President Bernard Jack Young has submitted a statement for the record, and I ask unanimous consent that it be included.
Without objection, so ordered.
Additionally, I ask that a statement from the National Community Reinvestment Coalition be also included in the record.
Thank you, Mr. Chairman. So, Mr. Kaufman, just address this with you. I agree with you that Fannie Mae and Freddie Mac could come into what we really need is the Federal Housing Finance Agency, who's now their overseer, should come in. And I would like very much for him to come in front of this committee so he could answer the question of why he's not acting aggressively enough to have these other, the big banks and everything who will make the ultimate decision on right now principle, why he's not insisting that they do that, particularly where it would save the taxpayer investor in this case, in Freddie Mac money, where actually getting a modification would save you more than going through the foreclosure procedure. He should come in, he should answer that, or he should pack up and leave on this basis of the administration you're going. They had the OCC, same thing. Why aren't they using their regulatory authority to get this thing resolved? He's making statements on regular different hearings about, worried about the condition of the banks. Banks have made more money in this past year than they were making before the recession. So I'm not sure we should be as worried about their financial health right now as we should about these homeowners like Mr. Matthews and people Ms. Wilson are dealing with and get them going. Maybe he can pack his bags and leave town if he can't see a way to do the job on that. But I hope the chairman gets a hearing and brings in the head of the Federal Housing Financial Agency, the OCC, the large banks, maybe start with the top 5 or whatever, and let them tell us why they can't recognize reality that someday they're going to have to acknowledge the point that all of those mortgage loans are not, that those properties aren't worth what they were worth before. And that in some instances they should and could write down the principle, but they all refuse to recognize that and take that step because they think somehow mystically it's going to come around and their books are going to balance out in the future. So, Mr. Kaufman, you've been helpful to us, and we thank you for that. Mr. Matthews and Ms. Wilson, thank you for your personal stories and the work that you're doing. And again, Mr. Matthews, to you, I hope that things resolve quickly and favorably for you. And you are so emblematic of so many people that call my office that it's, and Mr. Wilson told us the same. So we need to do something. Thank you all.
Thank you. Mr. Walker.
Thank you, Mr. Chairman, and thank you for holding this field hearing. And I thank you, each of you, for sharing your testimony with us, your thoughts and ideas. And I would agree with my good colleague from Vermont that we have a problem here now, and it's not so much the blame game, it's how we deal with it, how we complete the process and get ourselves back on track. And I think Mr. Matthews certainly illustrates something that puts a face in front of the problem, the key problem. But I think we would be remiss, too, on this committee and in Congress if we don't look back even further to 2006 or so when indicators are very clear. We're going to have a meltdown. Congress refused to act at that point. The leadership refused to take the necessary steps to say, yes, we've got a problem, and it's going to result in human suffering that we could deal with right now if we would do it. That didn't take place. Now we have the results. We can talk about cram down. We can talk about government getting involved. We can talk about whacking different entities in the process. But let us not forget that when the time was there, indicators were there that there was a financial crisis looming that was going to take this country to its knees to a great extent. It was not dealt with. And we would do well to remember that for the future. Thank you.
The ranking member.
Thank you very much. Just to you, Mr. Conlon, I know that the negotiations are going on with regard to this settlement. And when we read the newspaper articles about it and whatever, it sounds like it's going to be a robust settlement that's going to hopefully, I know it's a lot is in dispute, we're trying to figure it out, without disclosing anything that you shouldn't be. I'm just wondering, are you hopeful that that settlement, because it is going to resolve a number of these issues? Because just the other day, some of us met with Secretary Donovan and Secretary Geithner, and they seem to have some confidence. And I was just wondering, do you?
Yeah, we're hopeful. It's a robust group. It's certainly, the states have a lot of expertise in this area from the regulatory standpoint and from having managed
tried to deal with the fallout of what we've seen by banding together. We have an opportunity to have a voice that individually we haven't had. For those of us that have been in the group for going on 4 years, this is a real, finally an opportunity to really have a more meaningful discussion with teeth than any one of us can have on their own. At the end of the day, one of us keeps, as we talk about, it falls back, when am I going to put this guy out of business? And that's a tough threat in in a state where most people are still paying and need the services that this service provides on an ongoing basis. So, we're very helpful.
Again, I just want to thank all of our witnesses and everybody at the University of Maryland for all that you've done to make this happen. Mr. Chairman, I do appreciate you coming to Baltimore. As a matter of fact, within 2 minutes of my house, you can't do much better than that. Thank you very much. And to my colleagues, I thank you all.
Next time though, we got to figure out how to carpool. And with that, I too would like to thank all the witnesses and all those who attended the entire hearing. And with that, we stand adjourned.